Hello, good day. The purpose of this video is to help investors understand about exchange-traded funds. This video covers the details of how exchange-traded funds work, their unique investment and trading features. It is hoped that at the end of this video, students can understand how exchange-traded funds can be used in portfolio management. Stay tuned. Exchange-traded fund is an open-end fund that trades as a listed security on a stock exchange. It allows investors to trade portfolio of securities just as they do with shares of stock. We can also describe exchange-traded fund as a portfolio of stocks that can be bought or sold in a single trade. An exchange-traded fund aims to track or mimic the performance of an index, such as a stock index or a bond index. Nowadays, exchange-traded fund also provides access to a wide variety of markets and asset classes. Like stocks, exchange-traded funds can also be held for long-term capital appreciation. As we have just learned, exchange-traded fund provides access to a wide variety of markets and asset classes. What are the asset classes? Here is the list. The first exchange-traded fund was introduced in 1993. It was named SPDR, a nickname for SPDR, or Standard and Poor's Depository Receipt, which is a unique investment trust holding a portfolio matching the S&P 500 index. It was designed to duplicate the S&P 500 index. By year 2009, about 531 billion were invested in more than 700 U.S. exchange-traded funds. In 2010, assets under management in exchange-traded funds worldwide reached 1 trillion. Most exchange-traded funds attempt to match an index and are passive in their investment strategy. An exchange-traded fund generally uses indexing, often called passive management. Exchange-traded funds do not have managers with the discretion to try to pick winners. An exchange-traded fund offers market-level performance, as it aims to match the performance of a specific index, net of fund expenses. This slide shows some of the most popular exchange-traded funds in the world. Their names are special, such as SPDR, QQQ or Cubes, Diamond. All these exchange-traded funds represent the key market indices in US. What about Malaysia? In Malaysia, exchange-traded fund is relatively new. The first exchange-traded fund in Malaysia was launched in year 2009, which tracks the KLCI. Besides, there are exchange-traded funds that track the ASEAN and China market in Malaysia, offered by CIMB Bank. Malaysia also has a niche in Sharia-compliant equity exchange-traded funds. Investors can also have access to fixed income investment through ABFMY1, which is an exchange-traded fund that tracks the bond market. Exchange-traded funds are bought and sold on the secondary market at a market price. It can be purchased at a known price anytime markets are open. Therefore, their prices vary throughout the day. A number of factors influence the market price of an exchange-traded fund, including the share price movement of the underlying securities, currency exchange rate movements for international funds, and investor demand for the exchange-traded fund. The issuer calculates and publishes the net asset value of the exchange-traded fund daily. They base the NAV on the closing market prices of the securities in the underlying portfolio after fees and expenses. The market cost for a given exchange-traded fund can differ from the net asset value. Although exchange-traded funds can trade above or below the intraday NAV at a given point in time, there is an arbitrage mechanism that generally keeps an exchange-traded fund trading near its NAV. Now, let's have a quick question to test your understanding. What determines the price of an exchange-traded fund? Fill in the blank. The price of an exchange-traded fund is influenced by two forces, demand and supply. The price of an exchange-traded fund is usually very close to the NAV, net asset value of the fund, and will change throughout the days as they are bought and sold. The exchange-traded fund transactions take place in two interrelated markets. The exchange-traded fund market is made up of a primary and a secondary market. The primary exchange-traded fund market is made up of three major participants: the exchange-traded fund managers, the authorized participants, as well as the market makers. The fund manager is the issuer of an exchange-traded fund, who manages the exchange-traded fund and its underlying securities. The creation and redemption of shares are performed in the primary market. In the secondary market, investors buy and sell exchange-traded funds through stockbrokers. The exchange-traded fund is listed and traded in the stock exchange, just like any other common stocks. Exchange-traded funds generally charge lower fees than mutual funds. The actual cost to manage an exchange-traded fund vary, depending on portfolio complexity. Exchange-traded funds often have lower annual expense ratios compared to traditional index funds. However, they also have some upfront costs in the form of stockbroker commission and trading spreads. You will need to consider all of these costs before making a recommendation to a client. The arbitrageurs calculate the value of the exchange-traded fund continuously throughout the trading day. If the price of the exchange-traded fund moves from the value of the underlying stocks, an arbitrage opportunity arises. Arbitrage activity among the arbitrageurs and market makers ensure that the exchange-traded fund price trades in a range that sticks closely to the value of the underlying stocks. This gives investors confidence that the quoted market prices for an exchange-traded fund closely match the value of the underlying portfolio and index that the exchange-traded fund represents. If the exchange-traded fund price is higher than the NAV, arbitrageurs will simultaneously sell the exchange-traded fund, buy the underlying stocks, and exchange the stocks for new exchange-traded fund to cover their short position in exchange-traded fund. On the other hand, if the exchange-traded fund price is lower than the NAV, arbitrageurs will buy the exchange-traded fund in the open market, redeem those securities in exchange for the underlying stocks, and then sell the stocks in the open market for a profit. Exchange-traded funds have some unique characteristics that may make them useful for some investors. First, continuous trading. A significant advantage of exchange-traded funds over index mutual funds is that they can be bought and sold like common stock through an organized exchange or in an over-the-counter market. The portfolios are marked to market continuously, and investors can trade them all day long. at a price that is almost exactly the net asset value of the stocks in the index. As compared to mutual funds' net asset value is quoted only once a day. Second, liquidity. The ability to create and redeem exchange-traded fund securities on a regular basis ensures an underlying depth of liquidity. Third, costing. Exchange-traded funds are also cheaper than mutual funds. Investors who buy exchange-traded funds do so through brokers rather than buying directly from the fund. Therefore, the fund saves the cost of marketing itself directly to small investors. This reduction in expenses translates into lower management fees. Fourth, diversification. Exchange-traded funds enable investors to diversify portfolio in one trade. Exchange-traded funds invest in all or a representative sample of securities in an index, providing a highly diversified investment. This offers investors scale and access to a wide range of investment which may not be accessible otherwise to an individual investor. Further, they are backed by a sponsoring organization who can alter the composition of the underlying portfolio to reflect changes in the composition of the index. Fifth, transparency. With straightforward physical index exchange-traded funds, the issuer provides daily information to the market, including the exchange-traded fund basket or a close representation of the exchange-traded fund portfolio and the net asset value of the exchange-traded fund. This makes the exchange-traded funds a highly transparent investment option. And lastly, tax advantage. Exchange-traded funds also offer a potential tax advantage over mutual funds. When large numbers of mutual fund investors redeem their shares, the fund must sell securities to meet the redemptions. This can trigger capital gains taxes, which are passed through to and must be paid by the remaining shareholders. In contrast, when small investors wish to redeem their position in an exchange-traded fund, they simply sell their shares to other traders, with no need for the fund to sell any of the underlying portfolio. Large investors can exchange their exchange-traded fund shares for shares in the underlying portfolio. This form of redemption also avoids a tax event. In addition, exchange-traded funds have more flexibility to time the capital gain tax realizations. There are some disadvantages to exchange-traded funds. First, while mutual funds can be bought at no expense from no-load funds, exchange-traded funds must be purchased from brokers for a fee. Small investors may find the commission and bid-ask price expensive and may rather invest into open-end funds. Second, pricing. Exchange-traded funds trade at market price, not at NAV, as open-end funds would. Because exchange-traded funds are traded as securities, there is a possibility that their prices can depart by small amounts from the net asset value before arbitrage activity restores equality. Even small discrepancies can easily swamp the cost advantage of exchange-traded funds over mutual funds. Thus, exchange-traded funds could be expensive relative to open-end funds. And finally, dividend. Exchange-traded fund disadvantages also include the inability to reinvest dividends, except on a quarterly basis.
I hope you have learned something from this video. See you and goodbye.